Okay, welcome to the Future of Fossil Fuel panel, and I'm Dan Kamen, a professor here in the Energy and Resources Group and in the Goldman School of Policy and director of the Renewable and Appropriate Energy Laboratory. Before I introduce the speakers, and actually they will introduce themselves at a little more length, there'll be about 4 or 5 minute introductions per each one. We'll do kind of a lightning round of questions, so we're going to skip the long, thoughtful round and go straight into a lightning round of issues and then open things up for questions. So be formulating questions. We only have an hour and it's a really exceptional panel, so I want to take advantage of the opportunity to talk about these issues. So when people think about the future of fossil fuels, you get this incredible range of everything from all fossil fuels are going to be zeroed out in a decade's time to the amount of fossil fuels and the ability to clean them and manage them sustainably means that the fossil fuel energy system could last for a hugely long time, and that it's a very different worldview than maybe thought of as kind of the typical Berkeley picture. I was at Stanford's GSEP meeting just 48 hours ago, and there was a much bigger focus on this sort of panel than the typical BERC event. And so you get this very interesting mix of philosophies as well as perspectives on technology. And just kind of to set the stage a bit, one of the things that my laboratory on campus does is to build a series of capacity expansion models for energy systems. It's a model called Switch that one of my grad students built the first version of, and we've been expanding ever since. And so Switch, we have versions that cover Western North America, China, Chile, for strange reasons, Kosovo, Nicaragua, and we'll be releasing a version for India fairly soon. So it's a weird set of these models where we price out new generation capacity, various forms of demand-side management, and in particular, transmission and distribution. So it's a way to think through some of the scenarios. And in each of these places, you get a very consistent story, and that is that if your goal is 450 ppm or 7 nines reliability in your power system, whatever those constraints or goals might be, it's almost always possible to find many solutions that get there, that meet the environmental targets, that meet the reliability, or that meet various cost targets under a whole range of scenarios. In our modeling, we almost always, not almost always, we always work with a carbon price as a way to think these systems through. But what it says, if we can find 20 technically viable, meaning AC power flow, all of the nerdy stuff to think of how the system works, if we can find 20 viable solutions to meet China's announced carbon targets and climate targets a decade, 2 decades, 3 decades out, if we can find ways to do the same thing in Western North America, in Mexico, in Chile, what that says to me is that the technology platform is critical, but it doesn't determine where we're going. It's that mixture of policy, innovative private sector activity, the back and forth between what is a viable commercial strategy and what's a viable policy strategy. And so our panelists today are going to give us a variety of ways to think about questions like what fraction of the energy future in North America and China might be fossil, might be a strongly renewable-driven but fossil-supported, or nuclear/renewable, or nuclear-fossil renewable-driven. What mixture of those things we get looks very strongly to be a policy choice, not a technological or an economic inevitability. And so we'll really get some nice ways to jump into that in a second. I'm going to begin with Daniel Edgerton from C12, who will give us an introduction for a bit. We'll then jump to the end, and Robert Murphy, economist at Chevron, will give us a perspective. Jitesh Chanchani from DrillMap will give us a perspective on the kind of smart data, big data systems approach to the advances in the oil and gas industry, and Jane Long from the Center for Global Strategic Research at Lawrence Livermore National Laboratory will wrap up the introductory round. Sounds like from that smile I got the last word of your title wrong.
I'm retired.
Okay, so fair enough. Retired from Livermore. And so we'll do those quite quickly. I'll look agitated if one goes beyond 5 minutes. Then we'll get into a round of questions, and then again, get your questions ready, and we will examine the future of fossil fuels. So Daniel, welcome, and start us off.
Great. Thanks for all the organizers. I actually had the pleasure of putting these types of things together at MIT a few years back, and so I appreciate all the sort of hard work, thoughtfulness, evasion of thesis advisors and so forth that goes into these sorts of things. So when I last was doing this sort of thing at MIT back in '08, this is what the future of fossil fuels looked like. So here you can see the prices for oil, gas, and coal. At the time, basically everyone thought coal was going to make a big push because the prices were so low. Oil and gas prices were going skyrocketing high. Everyone was talking about peak oil. Cataclysms were almost inevitable, so on and so forth. And everyone had a myriad of predictions for how everything was going to shake out. Of course, I don't think anyone predicted this. Specifically, how much the prices plummeted, how much supplies increased. And I think it speaks to a couple of things. I think it speaks to one is it's almost a fool's errand to try and make predictions. And two is just kind of the power of technology. Now, that all being said, even though it's a bit of a fool's errand to try and make predictions, you still can't put your head in the sand either. You have to make choices about where you want to take your business, what you think you should be doing for policy, where you think opportunities are as an entrepreneur, and so forth. And so what I'm just going to briefly touch on is what we as one company, C12, faced and how, what we saw in the market and the changes that we made because of it. So we used to be a pure play CO2 storage business. We'd go out, we'd lease up acreage to store CO2 in deep saline aquifers and basically have kind of like a waste management model. We switched after about 3 to 4 years of operations into a CO2 enhanced oil recovery company because of some fundamental factors that we saw in the market that we felt like could not support our original business model as much as we would have liked to have seen that been successful. So what did we see? So the first thing is natural gas. So back when we started, everyone saw coal as being king, and there was a lot of, also at the same time, there was a new administration coming in, there was a lot of discussion around getting CO2 policies enacted. We didn't see that, and we saw prices for natural gas plummet to the point that there's a huge fuel switch over, meaning that a lot of the impetus for CO2 regulation, the foot got taken off the gas. Furthermore, all the gas into the system now is driving manufacturing back to the US. It's driving onshoring of a lot of petrochemical industries. Ammonia, this is a map of current and proposed ammonia plants. And these are some of the fundamental shifts that are going on that made us decide there's not a business in managing CO2 emissions primarily from coal plants anymore. We have to adapt. This is just power generation mix. It basically tells the same story over time. You can see the way that natural gas has cut into coal. If you translate through that to CO2 emissions, the CO2 emissions for the country actually dropped for a number of years. Again, taking a little bit of the foot off the gas and causing us to refocus our own business efforts. And then finally is CO2 regulation. We've actually seen a lot of great strides in the last few years, specifically CAFE standards, as well as EPA regulation on new and increasingly existing plants. However, there still is not any sort of long-term comprehensive CO2 regulation, which we feel like was needed to build a storage industry. And so, I guess, my takeaway from all this is, you can do CCS, you can do storage, but you need the market drivers, and you need the clear policy signals to do it. But otherwise, it's there. The opportunity is there. Now that said, we've been able to make a switch over to oil and gas and to do EOR, and there's an excellent, sort of opportunity there, and that still has an opportunity for CO2 mitigation. And so, the opportunities are there, but it's certainly a kind of a changing landscape. So. With that, I will turn it over.
So I didn't even pay him to say that policy was going to be the key driver on those, so that's perfect. So Robert, if we can get you to chime in from the Chevron perspective.
Absolutely, I guess I'll play the fool for Daniel. So I do a lot of the long-term forecasting at Chevron, or I'm part of the group that does. And so I thought it would be interesting just to sort of lay that out in terms of our long-term view and give a sense of that and help frame the debate for today. And our numbers are internal, but what I'll do is use the International Energy Agency numbers, the new policy scenario, which is relatively close to ours, and it's a good comparison. And basically, we have global energy demand growing by about 50% through 2035. The IEA is a little lower than that, about a third, and the difference really is that we see more demand for coal and more demand for renewables potentially than they do. Where that demand is coming from is really an emerging market story. Depending on the fuel, we basically see flat decline in demand in the US and Japan and Europe, whereas In terms of fossil fuels, what we're talking about here today, so the IEA a few years ago had about 82% of global energy demand coming from fossil fuels. That's basically talking about coal, oil, and natural gas. They have it fallen to about 76% by 2035. I see numbers that are very convincing that say argue for 70% is quite possible, but that's sort of the range and sort of give a sense of where the industry is going. Oil, to drill in a little bit, oil basically demand is declining in US, Europe, and Japan, but that's more than made up for in emerging markets, primarily China, India, Brazil, Sub-Saharan Africa, and the Middle East is a big center of demand. Gas is actually the fastest growing, and so Daniel touched on this a little bit. Natural gas is the fastest growing fossil fuel out there, and that's really strongly pinned to high growth for electricity. And that's both here in developed economies and also developing countries. And then coal. Coal is a big wild card. We see more demand for coal than the IEA does, and that's primarily because we see stronger growth in Asian economies, but that's really where the pull for that particular fuel comes from. Renewables, the flip side of this, is actually the fastest growing fuel source in our forecast. The IEA has it growing at about 7.5% per year, and really what that translates to is renewables, I'm talking about wind, solar, biofuels, and geothermal, make up about 1% of total energy demand today globally, and that rises to about 4% in their numbers. We see that being a little bit higher, a couple percent here and there about, but that's generally sort of the ballpark. And then the last piece I'll mention, I think it's critical, and it sort of sometimes falls by the wayside, is efficiency. So under our models and our forecast, we would see total demand about 20% higher if it wasn't for very active and continued investment in energy efficiency programs. And so basically that sort of frames where we stand today and where we're going. I think the key thing to note, though, is, as Daniel said, all of those numbers are wrong. I mean, they're inherently forecasted, they're inherently based on huge assumptions over massive uncertainties. And I think while that's challenging, I mean, these uncertainties are policy issues, they're technology issues, they're trade issues, they're what our future consumers look like and their behavior and their income distribution and so on. But all of those are actually huge opportunities because those are the points where we can sort of bend the shapes of the curve and get better outcomes than we see right now. Because I think both the numbers are just laid out probably aren't the ideal what we all want to see. I think that we'd like to move sort of the global energy economy in the right direction. And so those uncertainties are also big opportunities for us going forward. And we shall see.
Very good. Thanks so much, Robert. Jitesh, you're really at the forefront of kind of big data, smart systems in the sector. Can you give us your perspective and maybe explain a little bit more about DrillMap as well in terms
Sure. Thank you, Dan. And very thrilled to be here and sitting alongside these distinguished panelists. I work for a small software startup out of Houston and Austin, Texas. I'm a bit of the odd one here on this panel. My wife and I both work in the energy industry, and when I told her I'm going to a conference to talk about renewables, I had to sign paperwork. But it's great to be here. One of the things that what we've been fortunate to do at DrillMap is in some ways have a ringside seat and watch this whole unconventional shale exploration development landscape unfold. And it's been nothing short of breathtaking. It's for an industry that for the longest time was regarded as sort of slow to adopt technology and perhaps not be very progressive. It's actually quite remarkable to see what's happened in the last 5 to 10 years in every possible way, not only just in sort of the oil boom that we're seeing in this country, but also in sort of a way that actually has a positive impact on our carbon footprint in years to come. I'd be happy to talk a little bit more about that. What we do at DrillMap is we visualize and analyze a lot of market data about the energy industry in terms of drilling activity, production activity, rig movement, where permits are being filed. And we collate that with a lot of internal operational data that oil companies have so that they can view this information much more contextually and make decisions very, very fast, which is certainly a huge imperative if you're going to succeed in the unconventionals business, because it is a very, very high velocity business compared to kind of what we've seen the oil and gas business to be in the past. So again, I'd say for me, one of the main themes is that, you know, unconventionals is a big factor in how the energy landscape evolves. It is in some ways a bridge for us to get to the point where we have a much more sort of positive landscape as you know, as it relates to carbon footprint. It seems like it is the more realistic way for us to get there, and certainly one that, you know, everybody from a policy as well as market forces standpoint needs to kind of foster and figure out how to make it work.
Thank you so much, and thank all of you for being that efficient. That means we actually do get to have kind of more of the conversational approach, which is ideal. Let's start out by kind of thinking about some specific. Oh, Jane, sorry.
Not that retired.
So that's why we're ahead of schedule there. That's exactly why.
You really killed her today.
So Jane Long, formerly of Lawrence Livermore National Laboratory, now retired, although this is a pretty active version of retirement.
Yeah, I call it unretired.
Okay, there we go. Jane, you're
sort of like being undead. So I actually, just for context, I am currently working with the California Council on Science and Technology and chairing the response to Senate Bill 4, which is regulating hydraulic fracturing and other well stimulation technologies in the state. We're doing a scientific assessment of that right now, and I also work for the Environmental Defense Fund part-time. So I just want to try to put the fossil fuels issue in context a little bit from perspective of having looked at energy systems and trying to understand how you could get radical emission cuts by mid-century, which is really the goal. We really need to think about how we do that, and we need to be pragmatic about it. So I think we only have these few decades. We need to be very pragmatic and pretty much keep everything on the table. Nothing should be off the table. So I won't spend time talking about nuclear power, but we need nuclear power. And we're going to need to figure out how to deal with the fossil fuel issue. So if you look forward and just try to project out based on what we're doing now, what things might be like mid-century, it's very hard to get away from the idea that we're still going to need fuel. And if you add up what you think might come from biofuels, you could be very optimistic or less optimistic. But even if you're very optimistic, it probably isn't going to either fill the demand or be completely carbon-free. And that is problematic. Not that we should stop pursuing biofuels as part of the solution, but we need to also look elsewhere. And so we have this enduring need for fuel that is going to take place. And at the same time, we have a world that is awash in fossil fuel. I mean, literally awash. I mean, you're talking about gas being the fastest growing, but frankly, I think that's going to turn around and is beginning to turn around very quickly right now. It's going to be oil. And in fact, in the United States, and particularly in California, almost all the gas that's being produced is being produced out of oil wells. And so this hydraulic fracturing of source rock, this is different than what has been taking place in the past. This is where the oil was formed. And the ability to go down and hydraulically fracture that rock means that United States is now going to be the largest producer of oil. We're one of the largest producers of gas, and we have the largest reserves of coal. It is really our responsibility in this country to figure out how to deal with the fossil problem. And I think that the best thing to think about is how can this be part of the solution instead of part of the problem. So I agree. I think that we have to look at the companies that have this massive amount of resource. The world is not going to be driven in fossil fuel by supply anymore. It's going to be driven by demand, and demand is going to grow. So we have to deal with this problem. My sense is that these oil companies and fossil resource companies, they have a lot of the wherewithal, the technology, the understanding to get the molecules, to make them into some kind of fuel, and they have the technology to sequester the CO2 that will result. We need to tap into that. We need to figure out how these companies can be producing fuels that either don't produce carbon dioxide or use a fuel cell and produce a pure steam that can be captured on board, and that they are taking and they're using their expertise to put it underground again and keep it there. This isn't a solution for all time. This is a solution for the next 50 years, maybe the next century. We have to be pragmatic, and we have to figure out how to get these people this part of our energy world, which is a very big part of our energy world, to be part of the solution. Thanks.
Thanks a lot. Okay, now, that's why we were ahead of schedule. I appreciate it. So again, what I'd like to do is to get all the panelists to kind of respond to a couple questions to kind of get us going on a number of different technologies. And if we could start, and I think we'll just go down the table so I don't skip anybody at this time. So we'll go Robert and come towards me. So the question to begin with is, if you think about carbon capture and storage and where it is now and where it might be in the years to come, how might carbon capture complement or compete with any of the following? So nuclear, Jane mentioned, Jane mentioned nuclear power, solar and wind, biofuels, and then how might carbon capture and storage have one fossil compete with another? And so any of those you want to take on, nuclear, one fossil and another, solar and wind, and then biofuels. What role might carbon capture have in interacting with those? And if I can begin with you.
Relative to any of them.
Right. So just, in terms of your perspective, what do you see as the opportunities for competition or for complementing the role of those other technologies? If you think about where CCS might be going in the coming years.
Well, I think CCS is just part of the production process, depending on whether it's targeted electricity or, say, liquid fuels like Daniel. And so, in the end of the day, it fits in wherever it can be competitive. So if people won't pay the extra for CCS from electricity, and so the regulators won't pass the cost on, or the utility payers won't pay for it, then CCS can't plug into the electricity system, and so therefore wouldn't be necessarily competitive with gas or coal without carbon capture and sequestration. And the same thing, so if Daniel's company can produce oil that can be put to market with the cost being at below otherwise like global oil market rates, and then CCS can absolutely plug in. But because we sell commodities, people inherently won't pay any more than what the overall market rate is. And so CCS has to be a plug-in that can be economically viable.
So kind of one follow-on then, is there kind of a price point that Chevron thinks about in terms of what incremental cost of CCS keeps it competitive? Are there points where it gets, is there kind of gray areas where you stop thinking about it as part of that mix, or?
I don't know I haven't heard anything in terms of the Chevron's view. I think it depends country by country and sort of the individual market. I remember back when I was at the World Bank, we had a lot of CCS people coming in and talking about it, and their claims were sort of anything from $100 to $50 a ton would be required for the carbon cost. But
I mean, that's the kind of benchmark that you hear in the international discussion.
That's all I had of any sort of internal knowledge.
Okay. Jane, you really teed this up by highlighting the nuclear issue, keeping all technologies on the table. Where do you see that competition versus kind of co-evolution of CCS, both within the fossil sector, because there are some advantages doing CCS with certain technologies and others, and then in this broader discussion about how CCS complements or competes with renewables, with nuclear in particular, you highlighted it. Where do you see that mix going forward?
Yeah, so I think part of the problem is you've got these really, really low prices coming in gas and oil, and so until or unless you figure out how to bring a price for carbon into that system, you're not going to be getting the technologies that we need to fix the problem. So that's part of it. So California, take for example, we have cap and trade with a price coming forward. We also have for credits, and we also have low carbon fuel standard, which has the price for some of these credits. And there are companies that are coming in wanting to do electricity projects with gas, capture the CO2 and use it in EOR, and play in both the low carbon fuel standard and cap and trade. When these guys went to see talk to people at CARB, say a year ago, casual conversation, they would say, oh, well, don't try to play in cap and trade because people don't understand that you're really going to get rid of this CO2. So, it's too hard to understand that. So you should play in the low carbon fuel standard. And then just this last year, well, oh, no, don't play in the low carbon fuel standard because basically it's so good. The carbon sequestration is so good. There's so much carbon is taken out of the system that you'll bump all the biofuel out of the low carbon fuel system. So there's some ironies here. And I think if you level the playing field and allow this innovation to take place, you're going to get the best. You're going to get the best solutions, but you have to be careful that you put in a policy like a low carbon fuel standard, and you say it's about low carbon fuel, but it's really about biofuel. Then you've got conflicts, and you're not going to get these solutions. So I think it's really important that we keep climate in mind. So one small vignette, I was on a panel a couple of weeks ago or a month ago in Germany, and I was sitting there with one of the energy ministers in Germany, and he got up and said, our climate policy in Germany has these elements, and he started by, we're getting rid of nuclear power. And I looked at him and said, well, okay, you could have a lot of reasons for getting rid of nuclear power, I understand that, but don't count that as a climate policy. So keep in mind climate. It's really about reducing CO2. And once we level that playing field, I think and we get a price, I think we'll get these things going.
So I can't resist. We'll come back to it, but just keep in mind, you said, and when we get a price. And so we've had a number of forecasts. We have a price locally in California.
Right.
There's a price in British Columbia. We heard Jennifer talk about in the first panel. There's a small price in New England. There's a once high, now much lower price in Europe. Australia's backed away. So we'll come back at the end. Everyone will be thinking about how do we get that price? Does it need to be equivalent price? And so there's a lot of story in that will definitely impact how fossil fuels
just
play
to say, there are companies in California that, with the low price, even the low price we have now, who think between those two policies they could make it.
So unpack that a little bit.
Because they're selling it into the EOR market.
Okay, so that was the key feature. That
Right.
It's the economic returns of EOR.
That's why that's your business line.
Exactly. So okay.
That's the piece.
Okay.
Don't tell anyone.
Yeah. Okay. So just your turn to the same thing. Any of these competition, cooperation issues around CCS?
Sure. So I'm certainly not an expert in this area, but just putting together kind of everything that's been going on in the market. You look at all the cost overruns with a lot of the CCS projects and all the news about some of the cancellations, coupled with the fact that some of the cost curves on solar and wind seem to be coming down faster than what you've seen with CCS. And then when you add into that mix this huge glut of natural gas, both from sort of wells drilling for gas and also wells drilling for oil that are producing associated gas, which right now in a $3.75 price are being flared. When you put all that together, it seems intuitively at least that CCS is going to be under a lot of pressure and perhaps less competitive to some of these other renewable alternatives like solar and wind. But I'd love to hear what everybody else thinks about that.
So that sounds like a very Silicon Valley, not really the Houston answer to the question, which is interesting. So I don't think we had to sign papers to come here, actually. It's Daniel, your take on this.
Yeah, I would encourage everyone to think about industrial CO2 management on a supply curve basis. Don't think about it as a singular price point. You can make money today taking relatively pure streams of CO2 from industrial plants, bringing it to an oil field, and doing enhanced oil recovery. That's what we do. We're not alone. There's a lot of people that do that. As you move down that supply curve up in terms of cost of CO2 management, some of the next stages that you will get to are twofold. One is for pure play storage, is taking a pure stream of CO2 and storing it in, say, a saline aquifer. You can maybe do that for $25 a ton if you don't have a big transportation cost. If you're going after dilute streams of CO2, so this is when you think of power generation and combustion, if you do natural gas combustion, capture the CO2, take it to an oil field and do EOR, you also do not actually need that big of a price. You can, depending on the circumstances and the policy and for example, the public utility regulatory environment, you may only need, say, an additional $20 to $40 a ton. And so what I would say is, don't try and solve the problem 50 years out immediately. Don't try and think about capturing from existing coal plants and retrofitting them. Think about it as a supply curve, and there's a lot of opportunity to get CO2 out of the atmosphere by just sort of basically commercial opportunities and kind of judicious policy along the lines of what Jane suggested in terms of how you define low carbon fuel standard and what you allow to compete in sort of a low carbon marketplace.
So this is a really interesting kind of segue because it highlights that it's not a single price point, it's not a single technology, it's an overall perspective. I mean, we've kind of heard an economic version for you. Jane said you've got to think about this in terms of the overall climate problem you're addressing. So let me ask the kind of the question that often comes up in the eyes of both investors and regulators. And again, let's start with Robert and come this way again. That question would be, how should one think about this as a trade-off question between the economic benefits of low-cost fossil fuels today, and then a long-term perspective on addressing the climate problem, where if we take the IPCC as the standard, we're talking about a several-decade need to dramatically reduce the overall emissions, where all of these technologies are in play. How do you think about those investments? How do you think about the perspective around investments that look very good today? You know, if we have an internal price of carbon, if we have strong regulation in more parts of the world, that those investments could change dramatically in how they look over time. How does one think about, or what are some of the, you know, are there no regrets options in that space? Where do you kind of see that from an industry perspective?
Well, I think there's two separate parts to that almost. One is the idea of pricing carbon, which Chevron does, and I think most major producers now do as well. I think it'd be irresponsible for them and for their investors if they didn't. So that is built into all of our forecasts and project economics, and so we look at countries and regions where there is going to be a likelihood or an existing carbon price regime and build that in, absolutely. In terms of the policy decision and choice between short-term economic benefits versus sort of long-term costs that you're talking about, I think it's very difficult. I think that's the crux of the problem with international climate negotiations, is that each country has a different outlook on this, and so their short-term gain may be higher or lower, and in the long term, some countries are far more exposed than others to some of these long-term costs, and so this is why they're coming at it from completely different angles. Yeah. So like here in the U.S., I mean, Chevron, I think, and the industry as a whole, has had a huge economic impact in the last few years. And there's all kinds of outside studies and numbers in terms of the trillions of dollars it'll put into the economy and millions of jobs created and so on. And that's all well and good, and that's a critical part of what we do. So then how does a policymaker judge that near-term benefit against the long-term? That gets into sort of elections and sort of how they play that side of the game for themselves. I do think, though, it's not necessarily one or the other, that, for example, here in the U.S., the improvement in disposable income that has been made possible because of lowering energy costs here in this country hopefully helps rebuild the middle class. I think has definitely suffered in the last few years. And so that income plus manufacturing that's boosted by local energy sources, you have a stronger middle class, and middle class is inherently critical to having strong environmental policy. I mean, I've heard that sort of said by many people before, that sort of the middle class is essential to real strong and, I think, committed environmental values. And so do you, by improving the economy today, have a stronger and more profound response down the line? I think there's no easy answer. There's a spectrum. But in this country, the short-term benefits have been fairly clear, and then it's now a political question of how to value and deal with the long-term issues.
Jane, you've done a lot of work to highlight how hard some of these transitions would be, how getting low carbon, approaching zero carbon power in the long term is going to be a real challenge. How do you see this short-term, long-term one? Because ultimately, there's an opportunity cost, both financially, but politically, technologically, in terms of picking. Where do you put your eggs? Should you be saying, I'll only do fossil projects if I see them paying off entirely in 2 decades? I mean, that sounds like pretty harsh standards. Where do you think about this investment, what makes financial sense and what makes environmental sense?
Well, I think that the key thing right now is creating options, is that, because if we start looking at some of the work you've done, Dan, where you look at how these models are, how the economics of these decarbonization is going to take place towards the end of the mid-century, it gets extremely expensive. And my gut feeling about that is that you start early to make options available, you're going to decrease that cost. So, for example, coming back to CCS, I think it's critically important that, this, for example, the state of California get a project so we get our feet wet. We see what happens. We figure out how expensive it is or how to cut the costs or how to optimize it. That's one thing. The second thing is that I think these solutions are inherently going to be regional. We're just not going to, I mean, I've got a lot of friends going to all the COP meetings and they're headed towards Paris, but nobody thinks we're going to come back with a global decision about what we're going to do. And so you have inherently regional solutions. For example, if California got a CCS thing going, it started to work, I think that those ideas spread and we can learn from each other. China is a great example. I think China will move forward with nuclear power and CCS much faster than we will. We'll be learning from them. So the thing about the regional solutions is that you are, and I think the brilliance of the way the Obama administration is going to implement the Clean Air Act restriction of carbon dioxide is they are asking state by state for solutions. So you're going to get different solutions in different places, and we're going to have actually, Dan, I think you mentioned this a couple of years ago. You said we need laboratories. And these are going to be laboratories for how we do it, and it's going to be different in different places. What we need to do, I think, as a community of professionals is promulgate the mores of doing that. If you're San Francisco and you say you're going to reduce your emissions by not selling Hetchy power anymore, you are not following the rules. So I think we need to think about as a community what the mores are in reducing emissions, that they're not leaking it, that we're really counting correctly, that we're not obfuscating what we're doing. Those things are really important in that process. That's my two answers.
Jitesh, in terms of these laboratories of, whether it's laboratories of innovation or democracy, you deal directly with companies that are doing this. Are we exploring kind of the space of options? Are we making CCS a viable business product on these different scales?
I'd say yes is the short answer. It remains to be seen how serious a lot of these large E&P companies get about it. When I go and talk to a lot of these big companies about innovation, there's certainly more innovation going on in terms of how do I optimize my frac jobs. You look at the cost of a well. Today, it's $10 to $12 million, and half of that goes towards fracking the well. So there's a huge sort of focus on how do I bring that down, because 80% of those fracs don't contribute to production. I certainly don't have a sense that there's the same kind of urgency, if you will, on CCS projects, but that's my sort of perspective.
Daniel?
Yeah, I think it's interesting to look back at, say, the 70s in terms of what happened when there was sort of an energy crunch then. A lot of big energy companies went to look to do alternative energy projects. Now, at that time, alternative energies meant alternative supply. It didn't necessarily have a CO2 focus, so you had people going into oil shales and you had people going into biofuels and things of that nature. And I think the experience from a lot of the super majors, and Rob should chime in on this, is that they kind of got burned by it. Basically, they went outside of what they knew how to do well, and they kind of pulled back a little bit from it, and they did what Jitesh was talking about, which is they really focused on their own business. Lee Raymond at Exxon used to joke, I think we should make a big monument in front of our offices that just says crude oil on it to remind everyone of exactly what we do. I think that if you're looking for innovation, and if you look at sort of the history of where a lot of innovation has come from, certainly if the super majors can sort of jump in on that, that would be wonderful. But I think a sort of a more traditionally observed sort of path to innovation is you have sort of smaller companies, more entrepreneurial companies that are looking to sort of break the ground, prove that it can be done, and then, hopefully the super major will acquire you at the end of the day. And so I think that
there's no hinting at all there. I saw that.
And so I think that when you talk about expectations on industry, I think it's just good to be realistic, just in terms of where innovation has come from in the past and what we should be really looking for who to do, in kind of the different phases of development.
Okay. So let's turn a little bit to fracking, both the physical process, the frackable resources, and and the technology. And so when you think about the fracking boom and how rapidly it's gone in North America, there's a kind of common thread that you often hear, not entirely accurate, but that fracking has gone very quickly here, but the frackable resource in China is much larger than here, and many people have the bet that when China fully develops the infrastructure, they will go rapidly ahead, much more so than Russian resources. How do you see both, for example, US-based LNG exports, technology exports, and if we look back, say in 10 years from now, who would be the likely fracking leaders? Is it Argentina, Brazil, China, Indonesia? What might be that landscape looking like? Because that could really change the story, as you highlighted before, about CCS and just a huge push towards more and more exploration among low-cost fossils. So, Robert, begin with you again. We'll keep this pattern of going across the stage.
Yeah, so I guess on the first part of that, on the fracking side, globally, there's potentially a huge resource out there. I mean, the USGS and some of the surveys that sort of point to the huge numbers in China's and the Argentinas. A lot of potential, absolutely, and the technologies we used here are probably somewhat applicable, but I think there's very big differences in all of these locations, and it's not just the geology, which is a big factor, but you have, what was perfect about the US was you had the right geology, you had the right kind of pricing, you had the right legal and regulatory regimes, and so the environment was just set properly, and that sort of was a unique, potentially, opportunity. Whereas when you look in other countries, the geology might be more difficult. The land ownership structure and the way things work, where who owns the mineral rights, is it the landowner themselves or is it the state? That's a big question. How the gas or liquids are priced is very different in some of these countries. And so that inherently is probably going to make the growth in some of these locations slower. But having said that, the resource is definitely there, and you have very innovative companies applying some of these technologies we've taken from here and moving abroad. So over time, if the governments want to exploit these resources, they'll probably sort of move in that direction, whatever they need to sort of create the right kind of facilitating environment. Okay. And then in terms of your question of sort of LNG and the US impact, it is definitely going to have, gas markets globally are changing, and it's a really fascinating trend, and they're used to be very regionalized, and they still are to a significant degree, but that's breaking down, and LNG and the growth in pipeline gas is a big part of that. And so the difference between the US and Europe isn't as large in terms of price, so there may be a little bit of opportunity for LNG to move into Europe, which helps lower prices there potentially, and it gives them more supply opportunities when they're dealing with issues like Russia and sort of dependence on gas coming from their east. Looking at Asia, though, there's a much wider price differential. Yeah. And then you have the question of, so what does U.S. exports of LNG to the Pacific do? And then how does that combine with exports from Qatar and Australia, where Chevron's big, maybe potentially East Africa down the line? So there's a lot of moving parts, but I think the U.S. exports will probably have a downward pull on global gas prices. And so the rest of the world won't have as cheap gas as we have here, just because it's too expensive to go through the liquefaction process and then transport. So we're always going to have a bit of an advantage, and this is why manufacturing companies are locating themselves here now, because I think they see a sustained price advantage from being in the U.S.
Jane, is it resource, technology, economic? How do you see this?
I don't know if this is going to completely answer your question directly, but I just maybe tell a story instead. So I think in Pennsylvania, for example, where there's been a lot of angst about fracking, there's a Center for Sustainable Shale Gas Development, which is trying to sort of give environmental certification to fracking companies, which is at the highest possible level. And what you're seeing there is who's come to the table. The industry and environmental NGOs have come to the table, and they came to the table because it was gas, and because gas displaces coal. So, but what's happening now is that the story isn't going to be gas that much longer. It's going to be oil, and so we really have to start thinking about what that means for making an environmental contribution to the climate problem, because it's really going to be about oil. And that is kind of an underappreciated factor right now. So we think about fracking, we think about gas. The other thing is, you mentioned, Robert, the conditions were right. Well, the conditions were right because the oil industry was exempt from environmental regulation. And and they basically, by not disclosing the chemicals that they put underground, they lost their social license. And basically what's happening now is they're having to recover from that situation. So you see now Baker Hughes turning around and say, okay, we'll disclose, and state by state figuring out. And this is just an absolutely bizarre regulatory regime, because EPA was required not to regulate because they were exempt, the oil industry is exempt by Congress, by act of law, but they are allowed to give primacy to the state. And so in California, it's this fascinating regulatory regime, which, for example, if you might have noticed that the state of California Division of Oil and Gas had to shut down injection wells that were putting oil waste into freshwater aquifers. Yep. And this was actually signed into law as okay by Jerry Brown when he was first governor, and it was part of California having primacy over injection wells in California. Well, what's happened is the EPA wrote California a letter saying, account for this, right? So you have this really funny regulatory regime going on where the EPA is not allowed to regulate, but holds primacy over the heads of California and kind of noodles them into regulating. So I guess my point is, if we don't get the regulation right, it's not, the Europeans are all freaked out by the problem that we've had here with this regulatory regime. This is absolutely rife for green chemistry. They put 500 to 1,000 chemicals in these fracking fluids. A few of them are very toxic. Most of them are soap and gel. Why do we need 500 to 1,000? There is absolutely no reason that I can figure out. So we're rife to get it right. If we get it right, I think it will propagate. And the story is going to be oil, and we have to get that figured out.
Jitesh, what Jane highlighted is really the process that New York State went down, and regulating and moratoriums, et cetera. New York State versus Texas, very different regulatory environments for exactly this issue. How do you see this from kind of you're the smart guts of these operations, right? In terms of the thinking about the markets, the technology opportunities. What will drive the show here, or what should drive the show?
So since we're talking about export of technology or LNG, we started with fracking. I actually think it's a good thing. I think it's inevitable, and it's good for the U.S. to eventually figure out how to export the technology, because the national oil companies are buying their way into the shale business. They're learning fast, particularly China. They're actually well positioned to take advantage of what they learn from some of these technologies, because their geography, their all of it, at least on a relative basis, lends itself well to exploiting the shale resource, particularly when you compare it to Europe, where the population density is very high and the regulatory environment is perhaps not quite as permissive. So from that standpoint, I think if the U.S. were to just overtly take an approach of trying to export the technology, we're better positioned to make sure that it's done right and done in a way that's more conducive to a good environment in the future.
Okay. I want to get to Daniel, and then we'll go to all questions from the audience.
Dan, if you don't mind.
If it's 12 seconds.
12 seconds. So just keep in mind that the resource is really unknown, okay? I just want to say that EIA said California had 15 billion barrels of recoverable oil, potentially recoverable oil in the Monterey Formation 3 years ago. Last year they said, it's probably 0.6. So, we really don't know how big this is. It's important to know that.
Daniel?
I'm going to answer Dan's original question and say the United States and China in terms of where you're going to see a lot of activity, and here's why. To build on something Rob said, part of the reason why fracking took off in the U.S. is because private property-wise, if you own a parcel of land, you own from the center of the earth up to the heavens, right? And so it's your right to be able to lease that mineral extraction right to someone to go and get it. And
except for Hawaii.
Pardon me. And you get a royalty based off that, so you have an incentive to encourage extractive industries to come and make use of those resources, right? And so think of a 2x2 matrix where on the columns you have private property where the subsurface is owned by the surface owner, and where it's owned by the crown. So Europe, China, so forth. And then think of, on the columns, think of democracy, where people have a voice in sort of objection and, have a say in what goes on, and think of an autocracy. I think where you're going to see fracking development is where you have good geologic resource and where it's either a democracy that has private property rights vested with the surface owner, or it's an autocracy where you have crown-owned resource. So the United States and China are the two biggest ones in terms of land holding and geologic resource that fits that.
Excellent. I will thank you all. I want to open it up and get some questions. We don't have that much time, and so I'm hoping that someone happens to have the question around carbon pricing. But as it comes around, hint, hint.
Trying to lead the audience.
But please introduce yourself to make it a conversation. And if it's a question for one person, we'll direct it there first. But I suspect others may want to jump in. And so,
hi, my name is Ray, and I work for CalPERS. So this question is more directed towards Robert and Daniel. To build off of what Jane said, the availability of potential resources is really unknown. Right? And what we all know is that the shale technology suffers from very high declining rates, which are still rising. And we also know that because of the ample supply, prices have been really depressed. So what's, I guess, warding off from us from a scenario of today we have low energy prices, which kills off the competitiveness of clean energy, and by 2035, regardless of what form of energy that's in the energy supply mix, we're going to have high prices because the clean technology has not invested to bring the cost down.
I want to get you to the question part.
Sure.
Of this.
Whereas the traditional oil price has gone up by a lot because of limited supply. That's my question.
So just restate the question at the end.
The question is, would we have a case of limited investment and limited resource supply in the future such that both traditional and clean technology would be expensive by 2035?
I think, again...
Just look closer to the...
Yeah, I think I'm the reason the feedback's happening, though. But anyway, is this still on? Okay, easy answer to the question is that yes, that is a potential possibility in locations where fossil fuel prices are low enough that, or coal, or nuclear or hydro, that pushes out sort of newer renewable technologies. But I think there's a couple of caveats to that. I think one, it depends on the location. So Europe and China and Asia in general won't have access to the cheap gas that we have here in the US. So where solar or wind may suffer in the US, that won't be necessarily true elsewhere. The other part of that is that, of course, all of the subsidy regimes and so on and government incentives to promote some of these new technologies are adaptable and they keep moving them as they need to. And so you already have wind as competitive with the market prices in certain locations in the U.S., unsubsidized, I think maybe PV in certain cases too. And that with subsidies, they're sort of keeping those technologies below that line and keeping them in the market. So if the tolerance for that goes away, it's a problem. But otherwise, no, generally, I think the technologies, there's enough markets out there. There's a big globe with completely different energy prices all over it. And so there will be a market to test new technologies and develop them.
Daniel, you're implicated as well.
So just two quick thoughts. One is natural gas is about half the carbon intensity of coal in terms of power generation. So in terms of low price and ample supply for gas, I think it's actually cause for celebration. And then the second thing is that I think you're exactly right. I think that if we don't sort of get out in front of it and provide sort of clear signals in terms of where we want investment, we won't see it. And I think our experience with C12 is proof of that. We tried to make CO2 storage stick. We didn't see the path to market. It didn't emerge in a sufficient time, so we had to alter our own strategy.
Interesting, okay. I think we're going to have time for one more, as long as...
So in the past few months...
Just introduce yourself first.
I'm Dan Kern, and I'm at the hospital. In the past few months, we've seen a pretty dramatic decrease in the price of global crude oil. Does this change your forecasts for the long-term price of oil? And if so, what kind of implications does that have for the fuel mix?
That question was basically my last 2 weeks at work. But the answer is effectively not really, because we saw this coming. It's more of the view is as more of a transient issue, that basically there's a supply glut that's sort of come onto the market in oil. Primarily it's because Libya came back faster than expected. Iran has the potential to come back depending on how its nuclear deal works out. Iraq, ISIS issues aside, has sort of continued to boost production over the years. And then the U.S. The U.S. has sort of surprised everybody and continues to move the bar up in terms of what production will be like. And so in the near term, we were always expecting that prices would slip. And in theory, there's an OPEC response you would expect on the far side of that. But on balance, that the sort of trend on prices is relatively sort of flat going forward, whether you're looking at our industry costs or whether you're looking at what the oil price that a lot of these OPEC countries need to sort of break even from a fiscal budgetary perspective. I think this will probably be sort of a passing phase over the next few months. I mean, it does take sometimes up to a year for prices to sort of move their way through cycles. But no, I wouldn't expect oil prices to sort of collapse because of the recent news.
Past 5 years, oil has bounced around between basically 80 and 110. We're not out of that yet. It's gone through similar sort of cycles. You might have a different view that some fundamentals are different, but I concur generally with Rob's assessment.
We're gonna get the other group filing in a second. So Jane and Jitesh, could I get just a minute each? And then...
Just the sense about prices that there's been some talk about OPEC trying to drop the price to push the companies doing fracking in the United States who are pushing more oil into the world market now, beginning to export oil, that they would do what they did in the 70s, try to push these guys out of the market. And basically what I heard from several execs across the board in the industry a couple of weeks ago was make my day, that they're not going to get pushed out of the market this way, that they can make money at $70 a barrel. So I think we're reaching a kind of a place where supply doesn't control the price. It's going to be, there's going to be plenty. And I think the price could be low, and there's still going to be a lot.
Jitesh, you look up these market features, and you get the last word then before we have to close down before the keynote. So what's your thought on where we're going on this?
On what the price is going to be next month?
If you knew that, I know that the standard line is you would now be Secretary of Treasury. But aside from that, so.
No, I think there's no one answer. When we look at the shale plays, for instance, they all have different economics. And we hear that there are a lot of plays that are actually very viable even at a $70, $75 per barrel price for oil. So I don't know that there's one answer to say, this is when it's all going to start going down. But again, just one last thing I would say is I spent a year at IHS talking to, when I worked there, talking with a lot of folks that are sort of thought leaders in this whole space. And Dan Yergin actually painted kind of a scenario where there are three possibilities in the future. And there's sort of one, there's the sort of the vortex scenario where, bad things happen and all of a sudden everybody just goes back to completely focusing on fossil fuels. And then there's sort of the more middle of the road scenario called the global redesign, if you will, which is sort of the all of the above approach where unconventionals will continue to flourish and sort of take center stage, at least for the foreseeable future. But there will also be continued work towards renewables and other ways to do it. And I think that's really what is more likely to happen, because that's certainly something that works well in a combination of market forces and policy change.
I want to thank the panelists, and I want to thank the audience. And I think a takeaway from just the last comment was that if these technologies and these fossil fuel options are profitable today or profitable at 100 and above, and are profitable as you drop even 30% of that, that's a lot of supply and that's a lot of business opportunity that's going to make this space really active for a long time. So I want to thank you all, and I want to thank our BERC hosts for letting us run right to the last minute when they come downstairs. Thank you all, and I hope you stay for the keynote.